to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, the AI scare trade weighs on investor sentiment still, or again. We're going to have full market coverage ahead as the software sell-off simmers on Wall Street. Plus, we'll get a preview of Walmart's earnings results after the retailer's $1 trillion milestone. And we'll talk with the CEO of Dutch Bros as the stock soars following its earnings beat. But let's get to what's going on in the markets here. We have continued selling pressure here after the holiday weekend. People coming back to work and kind of in the same attitude of selling first and asking questions later, this concern that AI is going to eat not just software, but lots of other industries potentially as well. That's really the sentiment that's been weighing on markets recently. The Dow right now is off 180 points. The S&P 500 down 0.75%. Just a little point, though, of context here when we're talking about the S&P 500. Yes, it is down about 1% year to date, but we've still, these are near record levels that we have seen, and we're not that far off of those record levels. So even though the sentiment has been largely negative around tech, software, lots of other industries, we're really not off that much from the highs. For the NASDAQ, a little bit more of a disconnect there, but we are seeing it continue to be under pressure. But even so, down 4% year to date. That's obviously a bigger drop from that high where we saw the NASDAQ. And taking a look at the NASDAQ 100 here and the stocks that are under the most pressure, there's a lot of dark red here on the screen today, right? Even though a company like Micron, the thinking is that there will continue to be a lot of demand for memory chips. But that stock is under pressure. Will it be able to meet that demand? So in other words, it's not as though this is a question of software going away and that affecting Micron's business necessarily, unless you're sort of going a few steps down the road. NVIDIA, Microsoft, Alphabet, Amazon, Meta. The only real big one that's in green here today is shares of Apple, which are trading a bit higher. And then if you look at a little more software-focused screen here, you see that the selling continues there as well. And there, the year-to-date picture is pretty ugly here with a few exceptions. There's a green one. Zoom. It's down today, but it's up on the year, interestingly enough. So let's talk more about all of this now, because we see this weight in the market continue. Investors, of course, still anxious about the impact of AI on the software sector. Yes, there is the sell-off that we've been talking about in public markets. The anxiety seeped into credit, too. According to Bloomberg, more than 15% of U.S. leveraged technology loans are now marked at distressed levels. Our next guest says, stay away from those, maybe. Joining us for more is Joe Hegener, Asterozoa Capital CIO. Asterozoa invests in alternative assets like credit, but also in public markets. So you guys are across the board, and there goes my water bottle as I move over here. So Joe, we were just talking about what's going on in software stocks. Mm-hmm. Something interesting that we've also seen is that a lot of the companies that hold credit, that make loans to these type of companies, the Blackstones of the world, the Blue Owls of the world, have also been under pressure because they're seen as exposed to this theme. Where are we in all of this?
Oh man, it's an interesting dynamic over the last 5 to 10 years. Just the explosive growth of private credit and the sheer just volume of capital that has been raised vis-a-vis, private credit funds and business development companies and deploying, into not just, the software sector, but all sorts of different pockets of the market. One of the dynamics that I think I underappreciated last year and the year before was the relative increase in quality of the high yield corporate bond index as a function of some of the more distressed, more levered companies, that kind of the weaker credits, the double C's, the triple C's, if you will, that couldn't get financing in public markets. And so they turned to private credit, where it was actually quite easy to obtain financing. And so what you actually ended up having was the average credit quality of the publicly traded high yield index has gone up over time. Meanwhile, all those kind of speculative businesses, those bonds aren't publicly traded anymore. And so it's been really, really quiet in the publicly traded sphere. And yet the private credit loans, because they're not publicly traded, they're just held at NAV, and we're starting to see a little bit of disruption as it relates to, whether those marks are par or not.
I mean, that implies there could be more risk there.
Absolutely, yeah.
Right? Okay, so for people who are not steeped in private credit, which is, I would venture to say, 99.99% of the population, and even the investor base who aren't really that knowledgeable about it, what are the implications of that?
Okay, so I would say the positive is that I don't think, unless you look at like CLOs and leverage loans and things along those lines, I don't think that private credit funds in particular pose a systemic threat to our financial system. So that's vis-a-vis, a KKR or Blue Owl, to your point, or whoever, and they raised $10 billion for a new private credit fund. All those LPs knew exactly what they were getting into, and even if that fund underperforms and there are losses, it's not going to spill over like a mortgage-backed security market and on bank balance sheets and AIG and
it's
just
not
a systemic
enough.
issue. It's not necessarily big enough, but the amount of cross-contamination across corporate balance sheets, I don't think exists in the same way as problems that we've had in the past. But I would say that a material change in the availability of that credit could create a recession, right? So if there were steep losses in some of these private credit allocators and private credit funds, on a going forward basis, I think the small and mid-cap companies that have been relying on private credit to maintain their businesses and operate because they've been locked out of public markets, if that goes away, kind of like the banks when they pulled back and they stopped lending, in GFC, that could actually create a recessionary environment.
Will banks not come back into that market though? They're done.
Yeah, we're starting to see a little bit of risk-taking on regional bank balance sheets, but it's nowhere near the levels.
That's really interesting.
GFC.
Okay, and you said in your notes to us ahead of this, the biggest risk over the next 12 to 24 months is a financial markets accident. So if it's not an accident in the private credit markets, it sounds like you don't think it'll be, but what does that look like? What are the contenders?
Yeah, the reason we say that is just purely the sheer amount of leverage that we can see exists in the system, right? Whether we're looking at like the consumer and buy now, pay later applications and the rise of BNPL for rents and things along those lines, to corporate balance sheets, off balance sheet financing to facilitate the construction of data centers, to the cryptosphere, and I can sign up for a Robinhood account and get 100-to-1 leverage on name that coin that is inherently very speculative. And so there's just the sheer amount of leverage we see across every asset class in equities as well. Gives us a little bit of pause, especially considering where we are from a valuation standpoint. And and the last thing I'd say about that, I guess, is just the incredible moves in precious metals over the last handful of months we think is indicative of a very, very leveraged margin style dynamic where a very, very large asset class like silver or gold can be up 35% in a month and then fall by 20% in a day. That's unprecedented. And it reminds me a lot of kind of Archegos in a weird kind of rhymey Mark Twain way.
Okay, which was a fund that blew up. So what would the trigger be for a broader accident, I guess is the question. With gold and even with gold and silver, it's not entirely clear what the trigger was, right? We know it's probably not going to be higher rates as the trigger.
Potentially. Yeah, I think it's really difficult to identify what is the catalyst that is going to create the margin call dynamic. And it could be something as idiosyncratic as like a long-term capital management style blow up or an Archegos style blow up, right? And that could significantly impact markets in the short to medium term. And frankly, it's kind of a cop-out, right? But there's the known knowns and then there's unknown unknowns. And that's what I think we want to just be eyes wide open to.
Okay, so
going forward basis.
So then the question becomes, are you worried enough about this? Is the probability of that high enough that you protect yourself? And if you do, how do you do that?
So kind of ironically, I'm actually pretty optimistic and kind of bullish on risk assets in 2026. I do think that the tail risk to the downside is extreme because of the amount of leverage in the system and where our valuations are broadly. But there's an old Druckenmiller quote that I really like, and I'm going to totally butcher it. But it effectively is something along the lines of valuations don't inform me at all where the market's heading in the short to intermediate term basis. all it tells me is how bad things can get if the momentum reverses, right? You know, if it gets down to 14 times or 12 times, wow, this is historically very cheap and maybe I should look at buying. But as long as you have liquidity and kind of the technicals and the momentum at your back, that's much more indicative of where we're headed on over the next 3 to 6 months.
And those things are at our back.
And those things are 100% at our back, right?
So where are you seeing the biggest opportunities, especially since we've had a lot of dislocations in the market, software selling off, the gold and silver craziness?
Yeah, I think the software sell-off is probably the biggest opportunity I've seen so far in 2026. Just the amount of sheer indiscriminate selling across the board, assuming that every single one of these business models is going to be disrupted by AI, is just inherently false, right? Inevitably, there are going to be businesses that are going to be weaker and their moats are going to deteriorate and they're probably not going to be as competitive on a going forward basis. But there are also lots of companies in the software, particularly software infrastructure and kind of usage-based models as opposed to subscription-based models that we believe actually stand to thrive in this new AI world that could actually have a better product, a stickier product with, you know, exponentially higher usage and earnings growth over the next handful of years.
Why usage over? Because the question I keep asking everyone is, how do you know the difference between the ones that are going to do well and the ones that aren't going to do well? And you just gave us one metric, which is usage versus subscription. Yeah,
that's the main one that I'm looking at. I am not a tech expert, honestly. I'm a generalist, but the idea that a very, very large technology company with 100,000 employees and their entire revenue model is $10,000 per customer per seat on an annualized basis, right? A subscription model per seat. I think that business model is in jeopardy because it's going to be so much easier for small, mid, and large businesses to just create their own software and their own proprietary applications, right? But there are software businesses that are more infrastructure related where their business model is a function of the usage, right? It's actually making these AI tools in their processes more efficient. And you just saw in Datadog's earnings last week, like their usage demand is exploding as a function of Cloud Cowork and these new applications. So those are the types of businesses where their revenue is tied to the actual usage and not necessarily like a per seat subscription. And so those are the ones I think that are really, really interesting. And because we're kind of credit oriented, there are actually a lot of these businesses that have convertible bonds. These stocks have gone from, you know, there have been 50, 60% drawdowns in some case. And I can take investment grade credit risk to the downside vis-a-vis a convertible bond, a debt instrument tied to the company. But I get the equity upside if the stock recovers, because at any point in the future over the next handful of years, I can convert my note into shares if I want to. So I think that's a really interesting proposition. I have a 4-year or a 5-year call option where if I never exercise it, I just get all my money back plus a little bit of interest. And I've got that upside option, but the downside is IG credit.
Right, interesting. Joe, thanks so much for coming in. Great
Pleasure.
conversation, appreciate it. Coming up, Dutch Bros is laying out aggressive expansion plans for the coming years. We're talking to the CEO next on Market Catalysts. Dutch Bros is planning a big expansion in the years ahead, expecting to open at least 181 stores in 2026 and have, this is a good one, 2029 shops by 2029. Still, the shares have fallen more than 30% in the last year. There are some concerns about slowing demand and higher costs. And joining me now is Christine Barone, Dutch Bros CEO, alongside as well Yahoo Finance's Brooke DiPalma, who covers this sector and the stock closely. Christine, thanks a lot for being here. As you all push ahead for these pretty dramatic expansion plans, as you know, it's always a challenge when you're growing a company as much as you're expecting to grow Dutch Bros, to preserve the culture, not just of the employees internally, but also of the actual shops. And we can list the examples of maybe some competitors that got a little more institutional over time and the experience changed. How do you make sure that doesn't happen?
So the heart of the Dutch Bros brand is our people. And how we ensure that happens is we grow with our people. And so all of our operators that go into new markets and introduce our brand to new communities, they all started as broistas at Dutch Bros and have been with the brand on average over 7 years. And so that's really how we ensure that we continue to grow this incredible culture as we continue to expand across the country.
Christine, as you're expanding, you're also opening up maybe new types of stores. You experimenting currently with that walk-up location in LA. First question, how's it going? And two, can we expect a walk-up location here in New York?
So we have a great location now in downtown LA. And what allowed us to do that is we launched mobile order last year or the year before. And as we launched mobile order, it really gave us another channel to serve our customers. So when we went down to downtown LA, we still have two windows. Our operations work the same as they do with our drive-throughs. Instead of the party in the parking lot, we have a party on the patio. And so it's really working incredibly well. But it's our first shop, so going great. And we'll see where we take it from there.
All right, so Christine, any chance that a New York walk-up is coming anytime soon? And with that being said, how are you thinking about the cost of rent as maybe you do get into these bigger cities?
Yeah, so we're really focused on expanding from a drive-through perspective. We're focused on expanding to contiguous states to ensure that we've got teams ready to go to those states right now. I do think that LA opens other opportunities for us, but we're really focused on our core strategy right now.
Let's also talk about the food strategy a little bit as well, because I know you guys have been expanding more into food. What can you tell us about that? And also that a number of your locations don't accommodate food right now. So are you going to be doing any retrofitting or changing that at all?
Yeah, so as we roll out food, we shared that we were in 300 shops at the end of the year. So we've really been expanding this quite rapidly across our system. It's going incredibly well. And what we learn from our customers is we ask them all the time, what would you like from us? And they shared that, I love your coffee so much. I love your energy drinks, but I'd really love something in the morning to go along with that. And so as we looked at that, this is the number one thing that our customers were asking for. And as we roll it out, they're incredibly happy to see it as it comes.
When you think about the expansion of food itself, there's only a few items that make this up. I believe it's like 2 or 4 hot items alongside what you guys typically had. As you roll out, what are some of the challenges that your employees are up against? Are you physically putting in a kitchen?
Yeah, so we had 4 SKUs for a very long time, and what we're rolling out now is 8 SKUs. And so what we're very focused on being a beverage business first. We're very focused on ensuring that the complexity works within our shops and that we continue to serve our customers with speed, quality, and service. And so that always will come first. And so we're not really finding any complications as we roll out. I think our broistas are loving the food, and we're able to still ensure that we can serve those drinks very quickly as we add food.
So to go back to the expansion question for a moment, when we're talking about adding food, we're talking about also digging in, of course, on your core beverage business and the expansion. What's the biggest sort of bottleneck or roadblock you're coming up against in expansion? Is it finding the locations that you want, the real estate that you want? Is it getting the people that you want? I mean, as you talk about your people being a strength, where are you seeing that friction and how are you going about solving it?
Yeah, we're really not seeing roadblocks as we grow. So we did take some time a couple of years ago to reset, make sure that we had all the market planning tools in place, make sure that we had the teams in place to do everything. But we're really in great shape to continue on that trajectory to hit 2,029 shops in 2029. So feel that we have the people in place. We have 475 operators, which is there are people who sit just above our shops and go and open the new communities. So we're ready from a people perspective. I think as our brand becomes more well known, that developers are very excited to see a Dutch Bros come in. And so all of those things are going incredibly well.
Christine, on Wednesday evening, aired Thursday morning, I had the chance to chat with McDonald's CFO, who said that they had a very successful beverage launch. 1, how are you looking at that competition? And 2, what's been the impact of GLP-1s on your consumers?
Yeah, so we've been in this business since 1992. We grew up in the Pacific Northwest, so competition is certainly nothing new for us. I do think what we're seeing now is a recognition of how big the energy market is. We are the category creator of that energy segment. It's so customized at Dutch Bros. We have it blended, we have it iced, we can make it all different types of flavors. And so I think all of those things are really benefiting us, and others are starting to see just how large and growing this energy market can be. And then as far as GLP-1s go, we are all about customization. We launched protein at the beginning of 2024. We have 15 different sugar-free sauces and syrups. And so thinking of all the different ways that you might want to customize your beverage, we have that for you.
Christine, thanks a lot. Brooke, thanks a lot. Really appreciate it.
Thank you.
Coming up, we'll take a look at today's trending tickers. We'll be right back. Now time for some of today's trending tickers. We are watching Medtronic, General Mills, and Gemini Space Station. Markets and data editor Jared Blickery is here with me to chat these up. But first up, Medtronic shares, they are lower, even though the company did report better than expected revenue results. The medtech giant reporting a hit on profits because of increased costs weighing on earnings. It's also seeing a prolonged impact from tariffs. So we've been watching those shares. They're down about 2.5%. Not a huge decline.
Not a huge one. I think there were some expectations that we might have gotten a little bit of bump up in the guidance, which did not come, but not a terrible report. I do have some analyst commentary. Here's JP Morgan, which rates the stock a neutral, citing in general terms, it was a beat led by heart devices, but the stock is focused on what's next. Reiterated full year guide. An implicit guide lower for the fourth quarter should make this move more achievable. We wouldn't be surprised to see pressure on the shares as Q4 forecasts, along with perhaps full year 2027 plus, they move a bit lower. And then here's Leerink Partners, which rates the stock an outperform, saying analyst looks forward to management's commentary on the drivers of the third quarter performance and the assumptions underpinning the 2026 guidance. Just gets back to the guidance and maybe looking for something a little bit more, but saying, okay, what's next?
Yeah.
Just
show me the chart.
I was going to show you the chart. All right, let's go to the Wi-Fi Interactive. Here's what happened today. Let me just show you what's happening this year. You can see the stock almost back down to where it closed late December of last year. But here's the 10-year chart. This will show you what happened in the early pandemic when we saw all these medical device stocks really get a nice boom there. And then we saw that bad bear market, and we came right about to the halfway mark. So that's a place where that really attracts short sellers again, but we haven't seen too much of a decline from that. So I think just waiting for the next catalyst here, as we say quite a bit sometimes. But
from medical devices to cereal, let's talk about
nice
General Mills is cutting its fiscal sales outlook for the year. The maker of Cheerios pointing to weak sentiment and heightened uncertainty, putting pressure on consumer purchasing patterns. And this is the company that cut its prices actually in December. It talked about cutting prices. But, we know what's going on with the consumer and that, folks are making different choices.
That is true. Nevertheless, most staple stocks saw a really nice bump up in January and even into February. We're going to take a look at that in a second. But first, let's focus on some of the earnings details. What's driving the story right now? Management says consumer sentiment plus uncertainty, like we were just talking about, are slowing category growth and making volume recovery slower plus costlier. There's that tariff impact. I do have a quote from, let's see here, the General Mills statement itself. Weak consumer sentiment, heightened uncertainty, and significant volatility have weighed on category growth and impacted consumer purchase patterns. And let's go to Mizuho too as well. They rate the stock a neutral. Update is particularly disappointing given optimism expressed in the second quarter EPS in mid-December. So a little bit of disappointment there. If we go to the Wi-Fi Interactive, I will show you what General Mills is doing this year, and this is today. Let's switch over to year to date, and you can see kind of a rocky road there, but in the red for about minus 3.25%. Here is General Mills compared to its peers in the food space. This is the year to date, and here's General Mills. It is down 3.2%. Excuse that. And you can see most of the stocks up nicely. But there's Newell up almost 25%, Hershey up 20%, Pepsi and Coke up about 13%. So just hasn't been able to ride the momentum of some of its peers there.
Yeah, no, it has not. And then let's talk about a very different story. Major C-suite shakeup at Gemini Space Station. Just as a reminder, this is not a space station. It's a crypto company. It's a crypto exchange platform. It's parting ways with its chief operating officer, chief financial officer, and chief legal officer. And this comes just months after the company's IPO. And as a reminder, this is the Winklevoss-backed company, crypto company. So the shares are down because It's unusual to see an exodus like that, especially so shortly after the IPO.
Yes, we're arguably in a crypto winter, so it's not that difficult to understand that there's going to be a lot of pressure on the space, and you're going to see the same thing we've seen in past cycles, where you're going to have winners and losers. And I'm not trying to paint this stock as either of those, but you do have to give some attention to these big profile departures.
Yeah.
Let's go to the Wi-Fi Interactive, and here's Gemini since its IPO. You can see down 82%, and it IPO'd almost top tick from my memory. One of them, either the all-time high in Bitcoin or the retest of it. So it hasn't had that tailwind, that favorable tailwind of rising crypto prices that gets everybody excited. That's one of the things you want to look for in there. So back to the story, we do have some interims named. We have one in for the CFO, that's the Chief Financial Officer, another interim for the General Counsel, and looks like the COO, the Chief Operating Officer, will not have an interim.
That's
as
right.
Of right.
Do you have Coinbase on there somewhere?
I can
because
get that.
Coinbase is a company that's now been public long enough that it went through the prior crypto downturn, right? And and that happened, I guess, not too long after its IPO. So it saw a big drawdown, but then obviously saw, maybe we can max that chart out,
you bet.
and then we saw a recovery, and now it's coming back down. In other words, to your point, when you have a crypto winner, you have companies that are not as strong that don't make it. You have companies that are stronger that make it. Obviously, Coinbase survived the last one, but you can also see the shares are,
It's highly levered to Bitcoin. That's not a surprise. And all these exchanges, they want to diversify. They don't want to be this highly levered, but it's a very difficult thing to do once that's been your kind of story.
Yeah.
As you pointed out, this just reminded me, Coinbase IPO top tick Bitcoin in 2021, I believe. And so they had to ride that all the way down. You can't even see in this chart right now because that was right around the same time, though. And so they're in a similar situation right now. Bitcoin's going to take off again, I think, eventually. Is it going to be as flashy? I read a number of arguments that because it's been so financialized, you're not going to see these 500% rocket, to the moon gains like we saw in the past, but only history will tell.
We'll find out. Thanks, Jared.
Thank you.
Appreciate it. Coming up, the top analyst calls on Wall Street. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DiPalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Citigroup, DraftKings, and Shopify. First up, let's take a look at Citigroup. Morgan Stanley named the bank their top pick among large U.S. lenders. In the note, the analyst wrote that it sees another leg of outperformance ahead and raised its price target to 152. That's now the highest on the street. The average 12-month price target is 135. Next up, let's take a look at DraftKings. Deutsche Bank lowered its price target in the stock to $26 from $36. The analyst said it was based off of 2026 guidance that was towards the low end of expectations there. That's in addition to other pressure on results from increased promotions and slowing handle growth. Essentially, that's the dollar value of bets placed on the platform. The average 12-month price target is now roughly $37. Lastly, let's take a look at Shopify because Truist Securities upgraded the e-commerce platform to buy from hold. The analyst said it's one of a few software companies to show growth picking up lately. That's thanks to long-term drivers like international payments, its B2B platform, and agentic commerce. It also raised its price target to $150, up from $110, but that's still below the 12-month average of $160. Keep it right here on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the trading session.
Tax season is in full swing. A growing number of filers are turning to AI-powered tools to speed up preparation. Yahoo Finance's Josh Lipton spoke to Dan Geltrude. He's founder and CEO of Geltrude & Company about the accuracy and limitations of those tools.
Let's dig into this, Dan. So AI can now help you prepare a tax return. There are risks to that, Dan, and we'll dig into those. But I am curious. I mean, listen, you obviously know this business backwards and forwards. I'm curious to get your take on what you think maybe AI could be useful in with this, because I read reports, Dan, where folks say it could be helpful with certain tasks. Folks say extracting data or, maybe identifying overlooked deductions. But what do you think?
Well, let's keep in mind to start with that AI is not going to replace people completely. Now, there are certain functions that AI is certainly capable of assisting with, primarily when it comes to organizing data. That's what AI is really good at. So it certainly is a tool. It absolutely can assist in preparing tax returns, but it is not going to completely replace the human factor, at least not yet.
What could it get? I guess the question began, let's say you're using AI, right, to help you out with a tax return. What would be the worry? That it would get the math wrong, that it would misinterpret an issue? Like, what would be the concern to you?
Well, you bring up a good point there, because AI does not understand the taxpayer's intent, right? There is a human factor that goes into preparing a tax return. Let's put it this way. AI is extremely rigid in what it is programmed to do. So there is, shall we say, a limitation in judgment. And that's where the human factor comes in. And that's where people need to be careful. AI, again, is a great tool, but it is not fully developed to this point, and it does have shortcomings. And that's what people need to recognize.
Barron's dug into this, Dan. They had some great stats. I'll just read you one of them. In terms of the impact here, they say AI reduced prep time by 12% for people and up to 30% for some firms. Now that sounds pretty impressive. I guess your point is that, having said that, in your opinion, people still need to be involved in the process, at least now.
Absolutely. Look, if you take it from my standpoint related to it being an accounting firm who is preparing tax returns. So what happens is, at the lowest levels of the preparation process, and what is that? That is the input of data into the actual return. Yes, we are using AI in that regard, and it is a time saver. Now, what happens is that frees up time for tax preparers to be able to apply judgment into that return. Now, what do I mean by that? That is looking at audit risk, looking at the nature of deductions, things that seem out of place, too high, too low. And that is, again, the human factor that you need to consider when preparing a tax return. Yes, there's time saved in one area, but it allows for the human factor to be applied to other areas of tax preparation.
Are there certain folks, Dan, certain categories of workers where you would say, listen, if I were you, I would not be using AI tools at all, that your tax situation is just going to be too complicated?
Other than an extremely basic tax return, I believe that really everyone should be using a tax preparer. Now, that may seem self-serving, and I get it, but in defense of that comment, I would say when you have a good tax preparer, those are the people that can apply strategy and advice to your tax return. I just don't think that you're going to get that same level of insight from an AI function. So that's what I would say in terms of a good tax preparer should be saving you legally enough money to justify why you're using them.
Can I ask you, Dan, I'm sure there's some folks listening right now who say, well, what about TurboTax or H&R Block? I mean, their technology, their software, their tools. I don't know to what extent you have line of sight there, but would you say there are risks there, or that's just fundamentally different than the AI chatbots we're talking about?
Well, when you're comparing AI versus TurboTax versus an H&R Block, those are three completely different things. When you're using AI, it really depends on what the application of that AI is. When you're using TurboTax, you're actually preparing the tax return yourself. When you're going to an H&R Block, you actually have a human factor involved in their process. Now, I don't know to what extent H&R Block is using AI. I'm assuming they're at least starting to use some applications of AI. So really, the best of all worlds here is that you have a competent tax preparer that is using AI as a tool, as an assistant to be able to prepare a complete and accurate tax return.
Final question, Dan. If you spin out 5 years from now, and this technology is moving so fast, Dan, so quick. I mean, what kind of impact do you think AI is going to have on your industry?
Well, it's going to have a significant impact on the industry, just like it's going to impact all industries across everything, because AI is so powerful and we're really just starting to scratch the surface. So where are we going to be in 5 years? I couldn't even begin to guess. But again, I still go back to, as AI replaces certain functions, it is going to open the door for other types of services that people will need. I mean, a robot is not the same as a human. And at some point, if they can in fact replace humans, I don't know. I guess we'll all be sitting at home relaxing during tax season.
Dan, so good to have you on the show today. Thanks for your time. I appreciate it.
Thank you.
Coming up, Walmart crossed the $1 trillion market cap this year. What investors need to watch when they report earnings for the latest quarter later this week. Walmart is set to report earnings for its fourth quarter on Thursday. It comes as the nation's largest retailer recently crossed $1 trillion market cap, and new CEO John Furner took over. My next guest says a strong quarter is all but guaranteed, but you got to pay attention to the guidance. Could it provide some potential risk? Corey Tarlow is joining us now. Jefferies Senior VP of Equity Research joining me now. He covers this stock. So, Corey, good to see you. So, it sounds like you think the holiday season went pretty well for Walmart.
Yeah, morning, Julie, and thanks for having me. So the holiday season, I think, went very well. We saw across a number of retailers that reported preliminary sales in early January that they had record holidays for a number of retailers. So I don't think that Walmart's going to be deviating from that trend that we've seen from other retailers that have reported thus far. So we're at about 4.5% same-store sales growth for the fourth quarter. Consensus is closer to about a 4. So that's really not where we think the surprise lies. The surprise is probably more in kind of what the forward outlook is going to be. And we just think that the messaging there is going to be one of conservatism, very simply.
Yeah, I mean, I'm struck by General Mills coming out today and talking about, consumer sentiment continuing to be weak, heightened uncertainty. And obviously there's not a one-to-one comparison between a General Mills and a Walmart, but, they have some of the same customers who are buying those groceries at Walmart. So, how is that going to feed through then into that outlook?
It's a great question. And we also had Pepsi just a few weeks ago announce price cuts of up to 15%. Are they going to be that severe across the board? Probably not. But I think you have this is sort of culmination of lower inflation, of maximum fair pricing, which is going to put a cap on drug pricing in certain areas. You have the GLP-1 switching from an injectable to a pill. All of this presenting probably a little bit of a headwind to overall pricing growth. And pricing growth is a lot of times a benefit for retailers because it's more of a pass-through mechanism. But if you're going to see lower pricing growth in 2026 versus 2025, and I'll just give you a stat around this, food inflation in Walmart's business was, let's call it about 130 basis points in 2026. We see that potentially slowing to about 50 bips, which is probably about closer to normal in 2026. So the idea that they're going to post maybe or start at least the year at like a 4% plus comp growth is probably a bit too ambitious. And just for, again, historical context, the last 2 years, they've averaged, if you sans last 3 years, was 5% sales growth and about 10% profit growth. They probably just don't start there this year. So we think, and we put this in our research, maybe a 4% sales growth rate and like an 8% profit growth rate seems reasonable to start.
And is all of that enough to propel the stock higher from here, right? Like you have a buy rating on this thing, but you only have $132 price target, and that's where the stock is. So that doesn't imply, I mean, I know you can't tell me if you're going to raise it after they come out with their earnings, but we'll be watching for that, I guess. But so what's the catalyst for the stock going to be then?
Well, I think it's going to come in the form of higher earnings and potentially even a higher multiple as well. So if you look at the multiple today, it's 45 times. If you look at it relative to Costco's actually peaked in the mid 50s. So for a multiple to stretch for a retailer that's compounding, where it has consistent sales growth, accelerating profit growth, you do have the opportunity or the willingness for investors to pay more for that asset. But fundamentally, our upside case is actually our price target's 130 or around 130. Upside price target's actually 160. And that's based on an earnings number that's about $3.50 by fiscal 2028. And if you just hold the multiple relatively consistent at about 45 times, you can actually get to $160. And we don't think that is unreasonable in the case of outcomes for Walmart stock.
Corey, we haven't really talked about the new CEO, right? Tom Ferner, and not to mention that one of their main competitors, Target's getting a new CEO or has a new CEO in the form of Michael Fidelki as well. What do these guys need to? I mean, the job at Target is quite different than the job at Walmart now, I would argue. But let's start with Ferner. What do you think he needs to accomplish?
From John, I think we want just more of the same, because under Doug, we had a period of investment and then a period of harvesting those investments. And now Walmart's in the harvesting phase where you really have the opportunity to accelerate profitable growth. And e-com, which was a drag for this business for years, decades even, is now the growth engine for Walmart. So the focus, I think, and this is very clear if you look at the recent executive appointments that John Ferner made, over the last several weeks, because he appointed Dave Gugina to be CEO of Walmart US. Dave actually was previously leading the supply chain for Walmart and their e-commerce division. So it's a very kind of clear focus on driving profitable growth through e-commerce, which again is driving most of the growth. They posted a 4.5% same-store sales number in Q3. Of that 4.4 of those percentage points were driven by e-commerce. So that is where the growth is. And I think that's where John is most likely to be focused as we look ahead, because the store business, while it's very, very important and serves as sort of a nexus or a hub for its e-com business, the incrementality, if you will, is going to be stemming from the e-commerce growth.
So I got to ask you about Target before I let you go, Corey, because there, as I said, Michael Fidelki taking over, and you've held on to hope for this one, and it hasn't paid off. Is it finally going to pay off under him? What needs to happen there to turn Target's fortunes?
Well, it's done well in the last several months. But
you look at a 5-year chart of this thing, Corey. The last several months are like a blip.
Yes. That said, I think that what we were looking for Michael is very simple, and I asked this question on the last earnings call, is one word: change. Because that's what the market wanted when we got the CEO appointment. They wanted an outside perspective. But our thought is you don't necessarily need that. Let's look at what he's done so far to drive change in the business. He's taken down prices on thousands of items across the store. He has communicated that he's cutting up to 10% of headcount at the corporate headquarters in SG&A. So he's committed to driving market share through volume and lower prices, and then being disciplined on cost. And then lastly, they also talked about upping CapEx by up to 25%, going from $4 billion spent to up to $5 billion spent on things like stores, supply chain, AI, automation. I mean, these are the kinds of things, and Target owns almost all their real estate, by the way. So they have great assets that they can leverage within grocery, within general merchandise, within their private label business. And all of this kind of comes together, we think, very nicely, especially at this valuation, which is incredibly undemanding in our view, to help drive change, higher sales, higher numbers, and get back to more profitable growth for one of America's leading retailers, in our view.
I like that, an undemanding valuation. I love that descriptor, Corey. It's great to see you. Thanks a lot for joining us. And of course, we'll be watching for those Walmart and eventually for the Target numbers too. Thanks.
Thanks, Julie.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.